Ladies and gentlemen, what if I told you that the biggest move in silver won't be caused by inflation, shortages, or even industrial demand? What if the real force is something far larger, global capital searching for safety as confidence in governments, currencies, and sovereign debt begins to crack? History shows that every major financial turning point creates unexpected winners, and precious metals have always been among them. The question isn't whether silver can rise. The real question is whether most investors will recognize why it's rising before the opportunity is already passed. Markets have a habit of teaching the same lesson over and over again, yet each generation believes its own explanation is unique. Whenever silver begins to move, the discussion immediately turns to mining production, industrial consumption, solar panels, electronics, or whether there will be enough supply to satisfy demand. Those factors certainly influence price over shorter periods, but they rarely explain the kind of extraordinary revaluations that become part of financial history. Major price movements are not born in warehouses. They are born in the movement of capital across the global financial system. People tend to view silver as though it were simply another commodity. That is the first mistake. Commodities are consumed, monetary assets are accumulated. Silver has lived both lives throughout history. It has served civilization as money for thousands of years while simultaneously remaining an indispensable industrial metal. That dual identity means its price is never determined solely by fabrication demand or mine production. It is also influenced by confidence, or the lack of confidence, in financial assets, currencies, and governments themselves. History repeatedly demonstrates that financial crises do not begin because investors suddenly become fascinated with precious metals. They begin because confidence disappears somewhere else. Capital never sits still. It is constantly searching for safety, liquidity, and opportunity. When one destination becomes dangerous, money flows toward another. That migration of capital is what creates major revaluations. Consider the modern financial landscape. Governments across the developed world continue carrying debt burdens that would have been considered unimaginable only a few decades ago. Central banks have become increasingly involved in supporting government financing, stabilizing bond markets, and managing liquidity whenever financial stress emerges. Each intervention may calm markets temporarily, but it also reminds investors that the system has become increasingly dependent upon constant support. This is where most market observers become distracted. They focus on inflation reports released every month while ignoring the larger structural trend unfolding beneath them. Inflation is only one symptom. The deeper issue is confidence. Once confidence begins eroding, capital starts looking for alternatives regardless of whether consumer prices are rising rapidly or remaining relatively stable. That distinction matters because capital moves according to risk perception rather than economic theories. Investors managing billions of dollars cannot simply wait until every newspaper announces a crisis. They reposition gradually as conditions evolve. Sometimes those movements remain invisible for months or even years before prices fully reflect the underlying shift. Gold generally receives the first wave of defensive capital because of its larger market and deeper liquidity. Institutions, central banks, and sovereign wealth funds naturally gravitate toward the most established monetary asset. Yet silver occupies a unique position. Once confidence expands beyond gold alone, silver often experiences a much more dramatic response because its market is considerably smaller. It does not require enormous buying pressure to create significant price appreciation when available investment-grade silver represents only a tiny fraction of global financial assets. This is where simple supply and demand explanations begin to fail. Mine production may increase modestly, industrial demand may fluctuate. None of those adjustments compare with the scale of institutional capital seeking protection during periods of monetary uncertainty. Imagine even a small percentage of global pension funds, insurance companies, family offices, or sovereign investors deciding to diversify a fraction of their portfolios into precious metals. The amount of available silver capable of absorbing that capital is remarkably limited. Prices must adjust upward, not because factories suddenly require more metal, but because financial capital overwhelms available investment supply. Markets have experienced similar transitions before. During periods of monetary instability, investors stop asking how many ounces are mined every year. They begin asking how much metal is actually available for purchase at current prices. Those are entirely different questions. Another misconception involves the belief that silver simply follows inflation. Historical evidence suggests otherwise. There have been periods of elevated inflation where silver struggled, just as there have been periods of relatively moderate inflation during which precious metals advanced significantly. The common denominator has usually been changing confidence in financial assets rather than inflation statistics themselves. Confidence can disappear for many reasons. It may emerge from sovereign debt concerns, geopolitical instability, banking stress, declining confidence in government policy, or uncertainty surrounding international monetary arrangements. Whatever the catalyst, the destination often becomes the same. Capital seeks assets that exist outside political promises. Silver occupies an interesting position because it remains relatively overlooked by institutional investors compared with stocks, bonds, or even gold. That neglect creates opportunity. Markets often ignore an asset until conditions force participants to reconsider long-standing assumptions. When perception changes, repricing can occur with surprising speed. This is why major turning points often appear irrational to those relying exclusively upon traditional commodity analysis. Analysts continue publishing reports discussing mine output, while capital quietly reallocates across continents. By the time conventional explanations finally acknowledge the broader shift, prices have frequently traveled much farther than most believe possible. Financial markets have never rewarded consensus thinking during major transitions. They reward those who recognize structural changes before they become obvious. Capital rarely announces where it intends to go next. It simply begins moving. Prices follow afterward. Silver's long-term revaluation, therefore, is less about shortages than about confidence. It is less about industrial consumption than about financial migration. It is less about whether another mine opens somewhere in the world than about whether investors continue believing government debt, paper assets, and fiat currencies deserve the same level of trust they once commanded. The next significant chapter for silver may not begin with headlines celebrating industrial demand or mining disruptions. It may begin quietly, almost unnoticed, as global capital gradually changes direction. History suggests that once those flows gather momentum, they become extraordinarily difficult to reverse. By the time most observers identify the true cause, the market is already adjusted, and what appeared impossible only months earlier suddenly becomes accepted as inevitable. Every major monetary transition follows a recognizable pattern, although most people only notice it after the fact. Investors often assume that gold and silver move together because they are both precious metals, but history tells a more nuanced story. They are connected, yet they rarely move in exactly the same way or at the same pace. Gold typically attracts capital first because it has always been regarded as the world's primary monetary reserve asset. Silver, while sharing that monetary heritage, usually responds later, but when it does, its movements are often far more dramatic. This difference is not accidental. It reflects how capital behaves during periods of uncertainty. Large institutions, central banks, sovereign wealth funds, and major investors cannot reposition billions of dollars overnight into relatively small markets without creating significant disruptions. When confidence begins to weaken in financial assets, the first destination is usually the market that offers the greatest liquidity and the deepest pool of buyers and sellers. Gold has occupied that position for generations. The initial stages of financial stress are rarely driven by emotion. They are driven by risk management. Professional investors do not immediately search for maximum returns. They search for maximum stability. Gold satisfies that requirement better than almost any other tangible asset because it has centuries of monetary credibility behind it. Governments themselves continue to hold it as part of their reserves, reinforcing its role during periods of uncertainty. Once capital begins moving into gold, however, something important starts to develop beneath the surface. Confidence in precious metals as an asset class gradually increases. Investors who previously ignored the sector begin paying attention. Financial media start discussing higher prices. Portfolio managers who once dismissed the idea begin reconsidering their allocations. What initially appeared to be an isolated move slowly evolves into a broader monetary shift. Silver enters that process differently. Unlike gold, its market is considerably smaller, meaning that it takes far less capital to produce substantial price movements. This is why silver has earned a reputation for volatility throughout financial history. The same characteristic that causes sharp declines during periods of weak investment demand also creates explosive advances when capital begins flowing into the sector. Volatility is often misunderstood. Many assume it reflects greater risk alone, but volatility is simply a measure of how rapidly prices adjust when buyers and sellers compete for limited supply. Smaller markets naturally experience larger percentage movements because relatively modest changes in demand have a much greater impact on available inventory. This relationship becomes particularly important during monetary transitions. Gold establishes the direction. Silver amplifies it. History repeatedly demonstrates that investors initially seek certainty before they seek opportunity. Gold represents certainty. Once that confidence is established, participants begin looking for assets that offer greater leverage to the same underlying trend. Silver frequently becomes the next destination because it combines monetary characteristics with a much smaller market size. The transition rarely happens all at once. It unfolds in stages. Early buyers focus almost exclusively on gold. As prices strengthen and confidence builds, attention gradually shifts towards silver. Retail investors become more active. Institutional participation broadens. Momentum attracts additional capital. Each stage reinforces the next, creating a self-sustaining cycle that often surprises those expecting gradual, predictable price appreciation. Many analysts attempt to explain these advances using industrial demand or mining production, but those explanations often fail to account for the speed of the movement. Industrial consumption changes relatively slowly. Mining output requires years of planning, permitting, financing, and construction. Financial capital, on the other hand, can move across borders within hours. That difference explains why monetary flows frequently dominate pricing during periods of economic uncertainty. Another important distinction lies in perception. Gold is almost universally accepted as a monetary asset. Silver occupies a less defined position in modern financial markets. Some participants view it primarily as an industrial metal. Others recognize its historical monetary role. That mixed identity often delays investor interest until the broader precious metals trend becomes undeniable. Once that recognition occurs, the adjustment can be swift. Investors who previously considered silver irrelevant suddenly discover that the available market is much smaller than expected. Increased buying pressure quickly encounters limited supply, forcing prices higher in order to attract willing sellers. This dynamic has appeared repeatedly during previous cycles. Financial markets rarely reward late recognition. By the time mainstream investors fully understand why gold has been advancing, silver may already be entering the phase where percentage gains accelerate. That progression is not driven by excitement alone. It reflects the natural sequence of capital allocation. There is another psychological element that deserves attention. Investors often become comfortable purchasing gold because of its reputation for stability, yet hesitate when silver begins producing larger daily movements. Ironically, those larger swings are often a consequence of increasing investment demand rather than weakening fundamentals. Strong trends frequently produce higher volatility because markets must continuously adjust to accommodate expanding participation. This explains why periods of significant monetary change often appear chaotic in real time. Prices do not advance in straight lines. They surge, consolidate, retrace, and then continue higher as new buyers enter the market. Those fluctuations discourage impatient participants while rewarding those who understand the broader cycle. The relationship between gold and silver is therefore less about competition and more about sequence. Gold acts as the initial destination for defensive capital. Silver becomes the secondary wave once confidence in precious metals expands beyond the largest monetary asset. Their movements are connected through capital flows rather than simple commodity fundamentals. As financial uncertainty increases, investors naturally seek assets that exist outside the liabilities of governments and financial institutions. Gold satisfies that need first because of its global acceptance. Silver follows because it offers exposure to the same monetary trend within a much tighter market. The smaller size of that market magnifies both optimism and fear, creating the larger percentage movements that have characterized silver throughout history. Those who focus exclusively on daily price fluctuations often miss the broader picture. Monetary transitions unfold over years, not weeks. Within those longer cycles, volatility becomes part of the process rather than evidence against it. The strongest advances frequently emerge from periods that appear confusing and unstable while they are occurring. In the end, understanding the relationship between gold and silver means understanding how global capital behaves. Money first seeks safety, then opportunity. Gold fulfills the first objective. Silver increasingly fulfills the second. That sequence has repeated itself through multiple financial eras, and whenever confidence begins shifting away from traditional financial assets, it remains one of the most important patterns for investors to recognize before the majority finally notices what has already begun. One of the most consistent patterns in financial history is that the majority rarely arrives early. Investors like to believe they are forward-looking, yet most decisions are made in response to events that have already unfolded. Human nature has not changed for centuries. People seek confirmation before they act. Unfortunately, markets reward anticipation not confirmation. By the time the evidence becomes obvious enough to convince everyone, prices have usually adjusted to reflect that reality. This tendency is especially evident during major monetary transitions. In the early stages, price movements are often dismissed as temporary anomalies. Analysts search for short-term explanations, arguing that the advance is speculative, emotional, or unsupported by traditional valuation models. Because the move has not yet gained widespread acceptance, many investors conclude it will soon reverse. Waiting feels safe because uncertainty still dominates the conversation. The irony is that uncertainty is precisely when the greatest opportunities usually exist. Once certainty appears, opportunity becomes increasingly limited. Markets are mechanisms that constantly discount future expectations. They do not wait for newspaper headlines, television commentary, or public consensus before moving. Capital begins repositioning quietly, long before the average investor recognizes the significance of the trend. Professional money managers understand this reality. They cannot afford to wait until every indicator flashes green because the largest gains are often generated during the period when confidence remains low. Their objective is not to buy at the point of maximum optimism. Their objective is to identify changing conditions before they become obvious to everyone else. This creates a gap between institutional behavior and public behavior. Institutions gradually adjust portfolios over months or even years. Individual investors often remain inactive until dramatic headlines capture their attention. Once financial media begin covering rising prices daily, public participation accelerates rapidly. Unfortunately, that attention usually arrives well after the initial phase of the advance. History demonstrates that every major bull market follows a similar psychological progression. The first phase is characterized by disbelief. Prices rise, but few participants trust the move. Analysts continue predicting reversals. Investors remain comfortable holding traditional assets because recent experience reinforces familiar habits. The second phase brings growing recognition. The advance becomes difficult to ignore. More analysts revise their outlooks. Institutional participation broadens. Investors who previously dismissed the trend begin considering modest exposure. Confidence slowly improves, although skepticism remains widespread. The final phase is marked by enthusiasm. Financial news focuses almost exclusively on rising prices. Public participation expands dramatically. Individuals who ignored the market for years suddenly feel compelled to buy because everyone around them appears to be profiting. Fear of missing out replaces caution. Ironically, this is often when risk becomes greatest because expectations have already become excessively optimistic. The challenge for most investors is psychological rather than analytical. Acting before widespread agreement requires accepting temporary uncertainty. Humans naturally seek reassurance from the opinions of others. If everyone around them believes an investment is unnecessary or risky, hesitation feels reasonable. Yet, financial markets rarely produce exceptional returns through comfortable decisions. Another factor contributing to delayed participation is the tendency to anchor expectations to previous price levels. Investors remember where an asset traded several years earlier and assume those prices represent its true value. When markets advance substantially, they perceive higher prices as excessive simply because they differ from past experience. This mental anchor prevents them from recognizing that structural changes may have fundamentally altered the environment. Markets, however, are constantly evolving. Economic conditions change, monetary systems adapt, government policies shift, capital flows migrate across borders. When underlying conditions transform, historical price assumptions often lose their relevance. Investors who remain anchored to outdated reference points frequently underestimate the scale of emerging trends. There is also an important distinction between information and interpretation. Modern investors have access to unprecedented quantities of financial data, economic reports, central bank announcements, corporate earnings, and geopolitical developments are available instantly. Yet abundant information does not automatically produce better decisions. What matters is understanding how those developments influence long-term capital movement rather than reacting emotionally to each individual headline. This explains why many investors become trapped by short-term volatility. They interpret every temporary decline as proof that the broader trend has ended. Markets rarely move in straight lines. Significant advances are almost always interrupted by corrections that discourage impatient participants. Those corrections often create the illusion that the opportunity has disappeared when in reality they represent normal adjustments within a larger cycle. The media unintentionally reinforces this behavior. Dramatic headlines attract attention, while gradual structural changes receive far less coverage. As a result, investors become conditioned to respond to immediate events instead of focusing on long-term developments. By the time headlines overwhelmingly support a particular investment theme, the underlying trend has frequently matured. Another recurring mistake is believing there will always be ample time to participate once the direction becomes obvious. Financial history suggests otherwise. Major repricing events often accelerate unexpectedly. Markets can spend years building a foundation and then accomplish remarkable gains within relatively short periods. Investors waiting for the perfect moment frequently discover that the market has already moved beyond their comfort level. Confidence itself contributes to this acceleration. Rising prices attract attention. Attention attracts new buyers. Additional buying pushes prices even higher, creating a cycle that feeds upon itself. As confidence expands, skepticism diminishes, encouraging broader participation. Eventually, the pace of buying exceeds the willingness of existing holders to sell, forcing prices upward more rapidly. This does not mean every advance continues indefinitely. All markets experience cycles. Periods of optimism eventually give way to consolidation or correction. The critical point is that the largest portion of a long-term move often occurs before public participation reaches its peak. Those who wait for universal agreement usually sacrifice both timing and opportunity. Successful investing has never been about predicting every short-term fluctuation. It has been about recognizing major structural shifts before they become common knowledge. That requires patience, independent analysis, and the willingness to accept temporary uncertainty while broader trends develop. Financial markets consistently reward preparation more than reaction. Capital begins moving quietly. Institutional investors notice first. Public recognition follows later. By the time widespread excitement dominates conversations, much of the adjustment has already taken place. Those who understand the sequence recognize that waiting for complete certainty may feel comfortable, but history repeatedly shows that comfort and exceptional investment performance rarely arrive at the same moment.